Welcome to the Opening Bell Report.
Okay, I want you to picture a zombie. Not, the fast, scary kind.
Right, not 28 days later.
No, not at all. The slow, shuffling kind that everyone just ignores because it's basically already dead. That was Rackspace technology 48 hours ago.
It was the absolute definition of a company on life support. You wouldn't even poke it with a stick.
And then, February 18th happens, the opening bell rings, and this zombie doesn't just wake up, it sprints.
It breaks records.
We're looking at numbers today that honestly look like typos. We are talking about a stock ticker RXT that closed the day before at 42 cents.
Deep in penny stock land.
And it rocketed to $1.37. In one session, that's a 226% gain.
It's the kind of move that makes you check your screen, 3 times to see if there's a data glitch. It's just staggering.
Exactly, and the volume was even crazier. We saw over 500 million shares change hands.
And just for context, that's over 100 times their normal daily average. It's violent.
Violent is the right word. So that's our mission for this deep dive. We've got the comprehensive stock analysis report here, the charts, the news. We need to figure this out.
Is it real?
Yeah. Did Rackspace just save itself from bankruptcy? Or is this just a massive, massive trap for investors who like shiny things?
And that is the billion-dollar question. Because I think before anyone gets too excited, we have to be really careful. What we saw was a technical masterpiece, a perfect storm.
Okay.
But when you dig into the report, the fundamentals, the debt, the cash flow, that tells a much scarier, much more complex story.
So we have a technical masterpiece versus a fundamental nightmare. I love that. Let's start with the masterpiece. Take us back to the opening bell on February 18th. What happened?
Okay, so to get why this move was so violent, you have to see the setup. On February 17th, Rackspace is trading at 42 cents.
Right.
At that price, big institutions, pension funds, mutual funds, they usually can't even own it. Yeah. It's against their rules. It's off the radar. It is in the junk bin.
Invisible money, basically.
Totally invisible. Then news hits the wire. The next morning, the stock doesn't open at, say, 43 cents. It gaps up. It opens at $1 flat.
Okay, hang on. For anyone who's not a trader, let's unpack gapping up. Why does it matter that it skipped all those prices in between?
It's a sign of overwhelming immediate demand. It means overnight, the perception of value changed so much that no one was willing to sell for anything less than $1. In technical terms, we call this a breakaway gap.
A breakaway gap? Sounds dramatic.
It is. It signals the stock is physically breaking away from its old trading range. But the most important part isn't just that it opened higher, it's what happened after it opened.
It didn't just crash back down.
Exactly. Normally with these beaten down stocks, you see a pop on some news and then an immediate sell-off.
Right, everyone who's been stuck for months just gets out.
They say, thank goodness I can get my money back, and they sell. This didn't do that. It opened at $1, which is this huge psychological level, and buyers just kept stepping in.
All the way to a high of 171.
Before settling at 137. We call that a gap and go.
Gap and go. I like it. But let's talk about the fuel. You said 500 million shares traded. Does Rackspace even have that many shares?
That's the crazy part.
Huh.
That volume means the shares are changing hands over and over again. And a huge chunk of that buying pressure was almost certainly from a short squeeze.
I hear that term all the time. GameStop, AMC. But what was actually happening on the trading desks? Why were people squeezed?
So before the news, the analysis report estimates short interest was over 15%. That's very high.
Okay.
It means a lot of funds were borrowing Rackspace shares and selling them, betting the price would go to zero. They were betting on bankruptcy.
Betting the zombie would finally stay dead.
Precisely. And they were making good money on it too, until the 18th. When the stock opened at $1, every single one of those short sellers was instantly losing money.
And with a short position, your losses can be infinite, right? It's not like buying a stock.
Theoretically, yes. If the stock keeps climbing, you keep losing. So their risk managers are screaming at them to cover.
Which means they have to buy the stock.
They're forced to buy it back to close their position and stop the bleeding. They aren't buying because they suddenly love the company. They're buying out of terror.
So you've got terrified short sellers forced to buy, and then you have momentum traders who just see the big green candle and want a piece of the action.
And it creates a feedback loop. Panic buying leads to more panic buying. That's what made the move so explosive. It wasn't really efficient pricing. It was a liquidity event, a stampede for the exit.
Okay, that explains the how. A mechanical explosion. Now the why. Stocks don't just gap up 200%. What was the spark?
The spark was a press release that dropped right before the action. Rackspace announced a strategic partnership with Palantir Technologies.
Palantir. Okay, that's a serious name to drop. They're arguably the hottest name in AI software right now.
They absolutely are. And the deal is that Rackspace is becoming a primary infrastructure partner for Palantir's Foundry and their AIP, the artificial intelligence platform.
Help me connect these dots. Rackspace, for years, has been this kind of boring legacy web hosting company.
We landlord of the internet from 2010, yeah?
Exactly. So how do they suddenly fit into the super futuristic Palantir AI story?
That's the pivot. That is the narrative shift the market is buying. Rackspace is trying to shed that legacy landlord skin and rebrand as an AI infrastructure play.
But I have to be the skeptic here. Why does Palantir need Rackspace? I mean, they could run on Amazon, AWS, Google Cloud, Microsoft Azure. Those guys have infinite servers. Why go to a company that was trading at 40 cents?
This is the most fascinating part of this whole thing to me, because it says something about the AI market. Palantir's clients aren't your typical tech companies.
Right.
They're the Department of Defense, intelligence agencies, huge healthcare providers.
With secrets.
People with data that absolutely cannot leak. They're often legally forbidden from putting that data on a shared public cloud like AWS, where you're technically sharing physical hardware with millions of other people.
Yeah.
They need sovereignty.
Sovereignty, a private cloud, their own island.
Exactly. Rackspace specializes in private cloud single-tenant environments. The report suggests Palantir is using Rackspace to deploy their AI models in these secure, isolated bunkers. It's private AI.
So the pitch is, if you want to use Palantir's brain, but you need to keep it in your own private bunker, Rackspace builds the bunker for you.
That's it. And if that's true, Rackspace suddenly has a moat again. They can't compete with Amazon on scale or price. That battle was lost a decade ago.
Right.
But they can compete on security and privacy for these really high-value government and enterprise workloads.
That actually sounds like a real business model. It differentiates them.
It is. But, and this is a giant but, we have to look at the context here. A cool press release doesn't just erase a decade of bad decisions. We have to talk about why they were at 40 cents. You can't just ignore the history.
Yeah, let's do the history lesson. Because looking at this chart, this company used to be worth a lot more. This isn't some startup.
Far from it. Rackspace was a darling of the early cloud.
Yeah.
They were taken private by Apollo in 2016 and then re-IPO'd, went public again in 2020 at $21 a share.
$21 in 2020 to 40 cents in 2026. That's a 98% wipeout. What killed them?
In a word, commoditization. They were selling hosting when Amazon and Microsoft started selling cloud. It became a race to the bottom, and the hyperscalers just ate their lunch. Rackspace was left with shrinking revenues and no real identity.
The report calls it a distressed turnaround. That sounds polite.
It's polite for in the emergency room. I mean, look at the financials just before this jump. Revenue was shrinking 7% year over year.
Okay.
They had lost almost $1 billion, $863 million in the last 12 months.
$1 billion in losses. Wow.
And the cherry on top, the thing that really scares fundamental investors, is the debt. They have a debt pile of about $3 billion.
Wait, hold on. Say that again? $3 billion in debt.
Yes. $3 billion, with a B.
And before this jump, what was the total value of their stock? The market cap?
It was about $100 million.
That's terrifying math. They owed 30 times more than the company was even worth.
Correct. And that is why the stock was at 40 cents. The market was pricing in a Chapter 11 bankruptcy. It looked at the debt, the shrinking revenue, and said, the math doesn't work. This equity is going to zero.
And that context just makes the Palantir news even more dramatic. It wasn't just a partnership. It was a lifeline. It was the market saying, wait, maybe they don't die after all.
It's a repricing from dead to alive.
So let's look at the valuation now. How do we even put a price on a company like this? Normally, I'd ask for the PE ratio, price to earnings.
Yeah, you can throw the PE ratio right out the window. Rackspace has no earnings. Their EPS is negative $3.84. You can't use PE on a company that's losing that much money.
So what do we use? How do we know if $1.37 is cheap or expensive?
The report pivots to the price to sales ratio, or PS. This is useful for distressed companies. It basically asks, for every dollar of revenue the company brings in, how much are you paying for the stock?
And how did Rackspace look on that front?
Well, before the jump, Rackspace was trading at 0.12 times sales.
0.12.
Yeah. I mean, to put that in perspective, a healthy software company might trade at 3.0 or 4.0 times sales. Trading at 0.12 means the market thinks your revenue is basically worthless.
So even after tripling to $1.37, are they still technically cheap?
Technically, yes. Even at the new price, their PS is still hovering somewhere around 0.12 or 0.15. Their revenue base is huge, over $2.6 billion. The market cap is still tiny compared to sales.
So if, and it's a massive if, they can actually make those sales profitable, the stock is duck cheap.
Exactly. If they survive, it's the bargain of a lifetime. If they go bankrupt, it's a zero. There's really no middle ground here.
So who are their real competitors now? The report mentions DigitalOcean and Equinix.
Right. DigitalOcean, ticker DOCN, is the success story Rackspace wishes it was.
Yeah.
Developer-focused, high margins, trades at a price to sales of around 4.5.
Okay.
Then you have Kyndryl, the IBM spinoff, which is another turnaround play. Rackspace was sort of stuck in the middle.
The stuck in the middle problem. Too big to be niche, too small to be the giant.
Precisely. But this Palantir deal suggests they want to stop trying to be DigitalOcean and start trying to be Equinix.
Equinix is the data center company, right? The physical real estate.
Yes. Equinix provides the neutral ground where the internet connects.
Yeah.
They're massive. If Rackspace can position itself as the Equinix of AI, the neutral, secure, private layer for these sensitive models, that's a totally different business.
And a business that deserves a much higher valuation.
A much higher multiple. That's the bull case. That's the dream where this stock goes to $5, $10. But now we have to talk about the silent killer, buried in the financials.
Okay, be the buzzkill. What is it?
Cash flow. It's
Right.
easy to get excited about AI partnerships, but you have to pay your bills with cash.
So break down the cash flow quality. Why is it a killer?
Let's go back to that DigitalOcean comparison.
Yeah.
For every $100 in sales they make, they keep about $22 in free cash flow. That's a healthy business.
$22. Got it. And Rackspace.
For every $100 Rackspace brings in, they keep about $5.
5. That is razor thin.
It is. And the reason why is that $3 billion debt mountain. A huge chunk of their operating income goes immediately out the door just to pay interest to the bank. They're working incredibly hard just to stand still.
So even if this Palantir deal brings in a ton of new customers, if the margins aren't high enough,
It won't matter. If it's just low-margin consulting or reselling hardware, it won't generate enough cash to service the debt. They need software margins to dig out of this hole.
and this brings us to that idea of enterprise value. I think this is a light bulb moment for people who just look at a stock price.
It really is. Most people see the market cap, the value of the stock. But when you buy a stock, you're not just buying the good parts. You're inheriting its problems.
You're buying the house, but you're also taking over the mortgage.
Exactly. So Rackspace's market cap is roughly $0.3 billion. But the debt is $3.0 billion. The debt is 10 times bigger than the equity.
So the company is basically a giant pile of IOUs with a tiny sliver of stock sitting on top.
That's a great way to put it. When you buy the stock, you're betting that tiny sliver of equity won't get completely crushed by the mountain of debt.
And yet, despite that horror show, the stock tripled.
Because the market is forward-looking. The buyers today are ignoring the current shrinking revenue. They are betting on future growth. They believe the Palantir deal is the inflection point. They're paying for a future that has not happened yet.
It's a very brave bet. So looking ahead, what should we expect? Is this going to $2 or crashing back to 40 cents?
The report is clear. Expect extreme volatility. You have to remember, there's a gap in the chart between roughly 80 cents and $1.
And technical analysts hate gaps. They always say they need to be filled.
They do. It's very common for stock to dip back down to test that support level. But don't be surprised if you see it drop back to 80 or 90 cents. That would be a gap fill.
And if it drops to 80 cents, does that mean the party's over?
Not necessarily. It could be healthy. A breather. But, and this is the danger, if it drops back below the breakout point, back to 40 or 50 cents,
Right.
that's a dead cat bounce. That means the rally was fake.
On the flip side, if it holds above, say, $1.20.
If it can build a base there, the momentum traders might try to push it to test $2. That seems to be the next major resistance level.
But we don't have to guess for long. There's a date circled in red on the calendar here.
February 26, 2026. The next earnings report.
That is just days away. It feels incredibly risky to buy right before earnings.
It's the moment of truth. The press release got everyone excited,
Yeah.
but on that earnings call, the analysts are going to ask the tough questions. They're going to ask management to put a number on it.
They're going to say, show me the money. How much is Palantir actually going to pay you?
Exactly. If management says, we expect this to add $50 million in high margin revenue next quarter, the stock flies. But if they're vague, if they just talk about synergies and strategic alignment,
The market will punish them.
brutally, the stock could give back all of these gains in an hour.
So February 26th is the binary event. Until then, it's all just vibes and momentum.
It's a story stock. We're waiting to see if the story has a nonfiction section.
A story stock with a $3 billion anchor. Let's wrap this up. What's the summary verdict for the listener?
The summary is this. Rackspace was left for dead. The Palantir deal gave it a new narrative as a private AI infrastructure play. This caused a massive short squeeze. But the fundamentals, the debt, the low cash flow, are still incredibly dangerous. This is a high-risk, high-reward trade.
Not an investment for your retirement fund.
No, this is for the speculator who believes the turnaround is real, or for the trader just playing the volatility.
Okay, here's where it gets really interesting for me, and I want to leave you, the listener, with this final thought. We spend so much time talking about the giants, AWS, Google, Azure. We assume they own the future of AI. But this Rackspace situation hints at a fracture in that logic. If Palantir, one of the most sophisticated data companies on Earth, decided they couldn't use the public cloud for their most sensitive work, does that signal a massive shift? Are we moving toward a world of sovereign clouds for AI? And if we are, is Rackspace maybe the only cheap ticket to that ride?
Or that $3 billion anchor drags the whole ship to the bottom of the ocean before it ever gets there.
That is the risk you take. Thanks for diving in with us. We'll be watching that earnings call on the 26th.
Absolutely.
See you next time.
Don't forget to like, share, and subscribe for more.